All right, my name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So, today I wanted to talk about capital gains. I have received a call from my client asking about capital gains taxes and rates. They're going to have some capital gains shortly, and they just weren't quite sure how to handle that. So I wanted to just kind of walk through and give a brief explanation as far as how the capital gains tax game works, so you can better plan for your tax situation. So you actually have two forms of capital gains. You have short-term capital gains, and then you have long-term capital gains. And essentially, the difference is how long that you held the investment before you cashed out. So, short-term capital gain are any gains that you obtain in less than a full year, 365 days within 1 year. A long-term capital gain is considered any gain that you recognize after a year or later. So for example, if you have a stock, right, that's probably the most common capital gains is buying and selling stock. So buy a stock and you hold it for 3 months and then you sell it because it is under a year, it would be considered a short-term capital gain. If you took that same stock and you held it for, say, 18 months before you sold it, that would be considered a long-term capital gain. So there's your difference between long-term and short-term capital gains. And the reason why that's important is because IRS taxes is different, even though they're both capital gains. Short-term capital gains are treated rather differently than long-term capital gain. And long-term capital gains are treated actually more favorably than short-term capital gains. So the idea here was to encourage folks to make investments, make capital investments, invest in stock, invest in other capital assets for long periods of time. And the IRS wants to reward that sort of behavior versus doing it short term. The short-term capital gain, very simple. That's pretty straightforward. If you have any short-term capital gains, the IRS taxes that at your tax bracket rate, along with your other earned income. If you are in the 24% tax bracket, then any short-term capital gains will be taxed at 24%. If you are in the 35% tax bracket, it'll be taxed at 35%. And for those who aren't familiar, the tax bracket works on a graduated rate. So the higher your taxable income is, the higher the incremental tax rate is. So the highest rate is 37%. And without getting too far into the numbers of it, but that 37% depends upon your filing status. So the brackets are different depending upon your filing status. So that 37 threshold is going to be lower for someone that's single versus someone that's married, filing jointly. So again, I don't want to get into the numbers of telling you what the brackets are, but just understand the higher income, the higher the brackets are, and hence the higher your short-term capital gain taxes will be. So they essentially treat it as earned income. So earned income, job income, they essentially treat it the same. So where the interesting thing comes in is long-term capital gains, because it's treated quite differently. It's more favorable. And the top tax rate, again, this is just with the IRS, the top tax rate on a long-term capital gain is 20%. And that 20% also is dependent upon the bracket that you are in. And if your bracket is low enough, there's actually a chance that you can pay no taxes. So with the long-term capital gains, there's three tiers. There's three rates that you'll pay. Again, there's on the IRS side. So there's 0%. You can actually not pay anything on long-term capital gains. There's 15% and there's 20%. And that is all dependent upon your tax bracket as well. So the higher the bracket is, the higher that rate is going to be. So if you are in the 0 or 10% tax bracket, there's a chance that you could pay zero taxes. And if you're in I think the 24 bracket, then it jumps up to 15. And then if you're in the highest brackets, I think the 35, 37%, then you're going to pay 20%. But the key here to understand is that the most that you're going to pay on long-term capital gain, regardless of how much money that you make, is going to be 20%. So you can be in a 37% bracket for your regular income, but for your long-term capital gains, the most you're going to pay is 20%. So that's why I say that the IRS is more favorable for investing in things long term because they tax things at a lower rate than had you made that same investment on a short term basis. So that's the key here. So if you're into doing a little bit of tax planning, and if you're in a situation where your income fluctuates, to reduce the taxes that you may have on a capital gain, is see it. You can take the money out. Well, one, wait until you have a longer term capital gain. So if you're closer to that threshold for having an investment over a year, wait till you get to over a year. So that's step one. The other step that you'll want to take into consideration is if your income does fluctuate, you may want to see if you can take those gains in a year where you may have a lower income than others, simply because, again, the lower your regular tax rate is, the lower the capital gains tax rate. So that's some things you can do from a planning perspective. So I hope this helps. And if you have any more questions about this particular topic or any other tax or accounting related questions, feel free to reach out. I'm happy to help. All right. That's all for now. And I'll talk to you in the next